The bond market is a great way to diversify your portfolio, but it also tells us some cool things about what's really happening. So I brought on expert Peter Tchir of Academy Securities. Peter, thank you so much for taking the time. You really have come to the rescue.
Oh, well, thanks very much for having me on. It's been an interesting time for the bond markets and equity markets.
It really has been. So what are some big influencers happening in the bond market right now?
I think trade, so trade is influencing all markets. Questions about what's going on with trade have been a big influencer. What's going on in DC in terms of will we have some sort of impasse in the new year, or will it even be worse than that? Those have been probably the biggest topics in the bond market.
So Peter, you're mentioning some really risky situations right now. For someone who is a bond curious, I guess you could say, how do you recommend they get into the bond market?
So I think you're supposed to look at it more through ETFs, because I think it's very hard to do on an individual basis to find bonds that you want. The bid offer is going to be very high, so you're not going to get great execution. So I think the ETFs are probably the best way to do it. And within that, though, I would specialize. A lot of people put their money in AG or BND, so HYG or BND are two of the biggest bond ETFs, but they invest in the entire bond market. And I think with a little bit of thought and thinking how you view the world, you will find much better options that will treat you better from a return perspective.
That's great. I feel more comfortable talking ETF instead of going into the straight up bond market, but how long do you hold these?
I view them typically as trading strategies. So I'm thinking if I want something for the next few weeks to 6 months, ETFs are good. If I'm making a longer term commitment, I think then you want to go into mutual funds. And so when I look at a fixed income portfolio, I'd probably want to keep about 2/3 of that into investments that I like, whether it's a closed-end fund or a mutual fund, and then use maybe 1/3 of it to a half. That's where I'd want to trade around, try and maximize my potential return, and time the market a little bit.
Is the downtrend in HYG any concern to you?
Actually, not really. I think this is what we've kind of been looking for, right? I think there had been a lot of talk that HYG and the high yield market in particular was, priced too tight. That after years and years of chasing for yield, there was just no margin for error. And now we've had some things that have taken risk off across the board. That's made high yield go down in price. And to me, it's somewhat healthy. The oil also affects the high yield market. So those things have been going on. But what I do want to stress is this is not a case of high yield leading equities down. Equities have actually been leading credit markets wider. I think that's a really important distinction.
Where are we in the credit cycle?
I think we're middle to late stages of the easy part of the credit cycle. And now people are going to have to be a little bit more careful. But there's all this talk lately, oh, there's so many triple B bonds, oh, there's so much junk bonds, and everyone's kind of trying to say, oh, this is like 2007 or 2008, we have these problems in the credit market, and I think that's just purely wrong.
Meanwhile, the Fed is trying to raise rates, but financials aren't ripping. Wouldn't that go hand in hand?
I think everything's a bit concerned when the credit markets are weak. People are going to avoid the financials a little bit because, hey, they're the biggest lenders out there, so what's going on? But to me, I never really pay as much attention to the shape of the yield curve for the financials. I really tend to look at it as the state of the economy and transaction volumes. So on transaction volumes, housing's slowing down, right? That's big money, making those mortgages, making refis. When that slows down, that hurts the bank's earnings. Auto sales are slowing down. So I think it's a little bit more reaction to that and just part of this overall risk-off trade.
We're late in the credit cycle. Why don't you think there's going to be any problems?
Because we're already starting to see the behavior change of companies. And if you take a look at, say, GE, for example, there the stocks are way down. They've cut the dividend twice. They're doing things to protect that. Budweiser, same thing. The stock started going down. They've taken steps cutting the dividend to protect creditors. So I think we were in the 8th or 9th inning of this game where companies were able to use their balance sheet to support shareholders. Now, to support shareholders, they actually have to take care of their balance sheet. And a couple other quick examples, Newell Rubbermaid is now tendering for bonds. They started that, their stock price started going back up. AT&T, the CEO during their investor call, mentioned deleveraging as the best thing that they could do for equity holders. So I think you're going to see a shift in mentality where these highly levered companies are going to take care of their balance sheet. Let's be honest, this is not like 2007, 2008. These CEOs and CFOs, they don't sneeze without asking the rating agencies what would do. So they're well aware of the steps they have to take. They will not let credit conditions deteriorate. So I think that's going to be the big surprise. All these people very bearish about credit are going to realize the companies are well aware of what they need to do. They will take steps to do that. That will solve credit and will help the equities.
And GE will be okay?
I think so. It's going to take time. They have a much bigger problem. They think they have less transparency in some of their businesses, so I think they're going to have to be a little bit more forthcoming. But yeah, I don't see any immediate credit problems, and so long as they can get through the credit cycle, I think that lets these situations calm down.
Oh, I just hear the sigh of relief right now with a lot of people watching this.
Well, I hope I'm right on that.
What's your stance on the Fed, and where do you see the yield curve going?
I think the Fed has gone too far too fast. I think the original mistake was the Fed should have started hiking rates much sooner, maybe 2013, 2014. Instead, they waited for so long. But they're doing two things. So one, we're raising rates, and we're raising rates seemingly every 3 months. I think that we need time to digest that, especially when you see things like housing and autos selling off, which are rate sensitive. That's a sign, hey, maybe we're going too far too fast. Then at the same time, they're shrinking the balance sheet. They're reducing the size of the Fed's balance sheet by up to $50 billion a month. I think that quantitative tightening is part of the reason we're also seeing more volatility. So doing those two things hand in hand and quickly, I think that's been this recipe for volatility and bad, stock market.
Do you think they realize that?
I think they are starting to realize that. I think they painted themselves in a corner by talking data dependency, and some of the data they look at, like earnings, are still okay. I think if they take a step back, there's too much uncertainty around DC. There's too much uncertainty around global growth. Volatility is picking up. Financial conditions are getting worse. They're supposed to say, hey, let's give this 6 months, see how it plays out before raising again.
What about a risk of a recession?
Again, I think there's one theory that they're raising rates so they have some dry powder in case of a recession. I think they're going to cause the recession if they keep raising rates. So I think they've got to just take a step back and say, hey, we were at low rates for a really, really long time. 2-year treasury yields have doubled. People are reallocating their portfolios to safer investments because of that, which is okay, but let's let this take time. Let's watch autos, let's watch housing, let's watch the financials, let's watch global economy, and then we can go a little bit more aggressive again.
Will that help equities become more stable?
Yes, I think it would help equities become more stable, and that kind of comes back to my original view that this is an equity-led problem, not a credit-led problem. Because if it was a credit-led problem, then I think it's hard for equities to stabilize, because as the credit deteriorates, and we've seen this in a couple of companies out there, the bonds have gotten wider and the stock has a lot of trouble. This time it's the stocks go down so much that eventually there's pressure on the bond market. So once that levels off on the equity side, there won't be the pressure from the credit side. So I think this is relatively fixable, and it's probably one of the reasons we get these 30 and 40 point rises in the S&P.
Has that happened before, Peter?
I cannot remember the last time that we saw it there and watched markets trade like this. And the worst part for me is, I'm not even sure why I'm wrong on days or why I'm right. And I would just like to go back to where it feels like I said this didn't happen, therefore I'm wrong. Now you look, and 1 minute, by the time we're done this, S&Ps could be 25 points difference, and we won't even really be able to attribute it. That's very hard for traders.
Well, right now it looks like we're doing okay. Peter, thank you so much for shedding the light on this topic. Our viewers are going to be so excited. Like I said, you came to the rescue, and I know you're really busy, so we really appreciate it.
Thanks very much for having me.
Please come on again.
Definitely.
Awesome.